In today's video, we're going to go over the top 6 reasons that you may be about to overpay for life insurance. So if you're in the market for life insurance here in Canada, you're about to purchase it or you're about to apply for it, here are the top 6 reasons why you might be about to overpay for it. And stick around till number 6 because it is probably, in my opinion, the most expensive mistake you can make, as well as it's the one that most people make most frequently. So make sure you stick around to the end to find that one out. What's up, guys? For those of you who do not know me, my name is Philip Setter. I'm the founder and CEO of Affinity Life, which is an online life insurance brokerage here in Canada where you can actually view quotes 100% online and apply 100% online as well. So if that sounds interesting to you, I'll put the link in the description. But without further ado, let's just get right into the video. Okay, let's break into the top 6 reasons why you might be about to overpay for life insurance. And by the way, this isn't in any particular order, so it's not like number 1 is more important than number 6, but in no particular order, here's number 1. So number 1, you didn't shop around for life insurance. And now I know this seems maybe a little bit self-explanatory. However, let me break into it a little bit. So the way the life insurance works here in Canada, most of the companies in Canada, I would say probably 80 to 90% of the companies here in Canada that we have that offer life insurance do so by providing life insurance to what we call insurance brokers. They don't sell direct to the consumer. They sell through this broker channel, and through that broker channel, you usually work with someone and they have access to all these different companies. And from that, they say, okay, well, let's get your age, let's get your gender, let's get how healthy you are, your smoking status. And then they usually shop all these different companies and they find the best rate that's pertinent to you or particular to you, okay? However, there are probably about 10% of companies here in Canada, and I'm not going to say any names. However, they're just, for whatever reason, more expensive than the rest. They work with what's known as captive agents. So what that means is that you have an agent that only sells the products of that one specific company, and they're not going to source out all these different companies across Canada to make sure you're getting the best deal. Now, the problem with that is that maybe this company will have cheap prices for a certain demographic. So maybe it's 25 to 34-year-olds. Maybe it's males and maybe it's non-smokers. Let's just give that as an example. Well, maybe you're 42, so they're not the best company for you. However, if you're just working with that one company, you're not going to get the best rates available, pardon me, because you're just getting this one company rates. So 99% of the time, it's always best practice to work with an insurance broker that will actually source you companies from across Canada to make sure that whatever demographic you're in, whether it's 25 to 34, whatever age bracket, whatever gender, whatever smoking status, whatever health factors that you have, you're shopping all the companies in Canada to make sure that you get the best rate. Number 2, you have a bunch of costly add-ons. So listen, okay, nothing against all these additional add-ons and what they're known as is riders on a life insurance policy. These are just additional features that you can add on to a policy. So it could be maybe something like a hospital benefit. It might be something like an AD&D benefit, which stands for accidental death and dismemberment, or it could be a bunch of other riders. Now, listen, in my opinion, depending on what the rider is, 9 times out of 10, it's just going to be an unnecessary, costly add-on to your life insurance policy. If you went out to shop life insurance and you just went to get life insurance and then on the application say, oh, do you want to add this for, let's say, hospital benefit? Do you want to add this for your kids? Do you want to add this for maybe some other feature? At the end of the day, you went to go buy life insurance just for the purpose of getting life insurance. So all these unnecessary features and all these unnecessary riders that they tack on at the end that could add an extra 20, 30, 40% to your premium at the end of the day are probably going to be just an unnecessary add-on that maybe it seemed like a good idea at the time, but then once you actually dig into it, if you wanted that one specific feature, maybe it would be more costly to just go out and get that one product on its own. So listen, if you're in the market to just get life insurance, just get life insurance. You don't need to add all these unnecessary riders to it. Even though they seem like a good idea at the time, if you're looking for that one specific feature, maybe it's best to just find a product with that specific type of insurance or type of feature in mind. Number 3 sign that you're about to overpay for life insurance is the life insurance company doesn't require a medical exam. Now, I would say take this one with a grain of salt because especially after COVID, the necessity for a medical exam has gone down considerably depending on how much face amount you're applying for. Because before COVID, it was fine if someone came to your house and did a paramedical and took your blood and was face-to-face with you in close contact. But definitely as COVID happened and through that entire pandemic, the face-to-face interactions was really reduced to a minimum for only clients that absolutely needed it. So typically now, the larger the face amount, the better the chance that you will require a medical exam. However, with that being said, there is a genre, I'll say, or a category of life insurance called simplified issue life insurance. Now, this might be, you might hear some other names, guaranteed life insurance, simplified life insurance. These can be good options for a select group of people. Usually that's people with maybe adverse lifestyle decisions like extreme hobbies, climbing, paragliding, hang gliding, etc. Or maybe people with adverse health conditions, such as maybe diabetes or other health conditions similar to that. In that case, simplified issue could be the best option, and that won't have a medical exam. However, if you're a healthy individual and all other things with you relatively equal, you have a good driving record, good financials, no adverse lifestyle decisions, and you're applying for $1 million plus of life insurance and they don't require a medical exam, there might be something wrong there. You might be applying for a product that is way more expensive than you should be getting, and it's probably best if you just went the traditional life insurance route and you had a medical exam and they actually said, okay, no, you are incredibly healthy. We're going to give you the most preferential rate. Number 4, you're buying way too much coverage. Okay, so here's the thing. Life insurance is meant to help those in your life that financially rely upon you. And if you passed away, they would be financially impacted. So usually this is going to be your partner and your children. That's 9 times out of 10. There are obviously other scenarios. Maybe if you had a disabled child, that would be something that you need to take care for the rest of their life. If you had parents that were aging and they were relying upon you to take care of them, that's another reason why you might get it. But at the end of the day, life insurance is meant for those that financially rely upon you, your loved ones in your life. And if you were to pass away, they would be financially impacted. That's the reason for life insurance. Now, with that being said, that main goal is to replace the financial earnings that you bring in. So 9 times out of 10, that's going to be your income. There's obviously other things that you want to take into consideration as well, like outstanding mortgage, debt, credit cards, car payments, whatever it is. However, at the end of the day, we're not trying to enrich the lives of our family if we were to pass away. We're not trying to leave them behind this massive inheritance or massive life insurance policy that now they never have to work for the rest of their life. That's not the point of it. The point is to help them during a time when they're going to be grieving and they're going to need to have that financial support that you brought into the family. So picking a life insurance coverage that's not meant to enrich them, it's meant to take care of them, but it's not meant to set them up for the rest of your life. That's not the point of life insurance. So buying too much coverage is definitely one way you're going to overpay for life insurance. And by the way, if you wanted to know how much life insurance coverage you should get, we have a needs analysis and recommendation quiz on the website, and you can check that out again, affinitylife.ca, and the description, the link, pardon me, is in the description below. But you can take that quiz and we will tell you exactly how much we would recommend. But at the end of the day, it's not meant to enrich the lives of your family. It's meant to help them out during a time of grieving. Number 5 that you're about to overpay for life insurance is your term is too long. So this applies for term life insurance. Now, term life insurance works where you pick a term, and it could be a term 10, a term 20, a term 30, a term 40, a term 50, a term to 100. There's a multiple different amount of terms that you can pick. Now, when choosing a term, you want to choose it for an amount of time that you'll need it for. I mean, that's pretty self-explanatory. However, some term policies may go way longer than you actually need them for. Typically, life insurance and term life insurance specifically is meant to cover you for a very specific amount of time when your family is going to be most vulnerable. Pardon me. So when is that? Well, let's think about that. That's when your kids are just growing up. They're just going to school. Your family is, maybe they're in a new house, maybe you have a new car, maybe you start a new job. And if you were to pass away, your family would be left with quite a crater of a financial impact that's put upon them. So if we play that scenario out, well, what happens? The kids start to get older. We start to get a little bit more comfortable with our finances. We start to get more savings. We start to pay down our house. We start to pay off our car. We start to get a little bit more ahead in life. We start to get investments. And as we get older, 40, 45, 50, 55, the need for that life insurance starts to decline as we get older, of course, because now the kids are out of the house eventually. They're in university. Our wife has investments. Our husband has investments. Our partner is now starting to become more financially stable without us if something were to happen. So the need for life insurance is dwindling over time. So you don't need a term 10, a term 20, a term 30, or whatever it is to last you until age 75, age 85, age 95. That doesn't make sense. If we start to get our house paid off, our car paid off, and financial stability within the family, we can start to cancel our life insurance policies and not pay for these things that aren't needed. So when picking a term life insurance length, you want to pick something that makes sense. When do I think that I'm going to be financially stable, where if something were to happen to me, my spouse or my partner or my family would financially be okay at that point? And number 6, finally, the last reason or the last sign that you're about to overpay for life insurance is it's pitched to you as an investment. Now, I have some pretty strong opinions on this, and I'm going to break it down for you. You've probably heard this before. There's a staggering amount of advisors in Canada that will recommend the idea that, hey, well, you need life insurance, and you know what? You might need this investment as well. So why don't you just get 2 birds, 1 stone? Let's buy life insurance with an investment component, and then we can use that during retirement and supplement our retirement income. We can pull an income from it, and we can also have this permanent life insurance, and we also have life insurance through our entire life. So we have this coverage, and we also have this investment. Now, here's my opinion on the matter. And by the way, I made a lengthy video on this. I'm not going to get into it right now, but I made a lengthy 40-minute video breaking down the math of why I think this is a bad idea for the vast majority of Canadians. If you're interested in that, just drop a comment below asking for the video, pardon me, and I'll put it down there. However, here it is. Investing in life insurance for the vast majority of Canadians is an incredibly bad idea, and here's why. There's multiple strings that are attached to it. It's a very complicated strategy that at the end of the day, if you compare it apples to apples to just traditionally investing into an RRSP, it will not make sense. So at the end of the day, if you're like most Canadians and you're still struggling to max out your RRSPs, max out your TFSA, get your debt paid down, investing in life insurance is the last thing that you should look at. Sure, if you have all those other things taken care of, if you don't have any high interest debt that you're servicing every month and paying 10, 15, 20% on a credit card or something like that, if you have your RRSP max and your TFSA max, then yeah, it could be a good idea. But for the vast majority of Canadians, I think it's a very bad idea. And apples to apples, if you compare it to an RRSP, you'll be way better ahead if you just invest into a traditional strategy such as an RRSP that the government has put in place. There's no strings attached to it. There's no things that could really go wrong at the end of the day. It's just an investment within a sheltered account. So with all that being said, if you're like most Canadians and you fall into that category, it's a bad idea to invest in life insurance. If you're part of the small majority that have all those things taken care of and you're a high income earner, you have extra cash to allocate, it might be a good idea. And again, I made that video. If you're interested in it, put in the comments below and I will link that down there. But with that being said, that's all I can say about this topic. If you guys have any questions, feel free to drop them in the comments below. And if you guys are enjoying this content, all I ask is that you give it a thumbs up. And I'll see you guys in the next one.